Let's welcome in our next guest, Rohit Agarwal, Equity Fund Manager at Kotak Life Insurance, is now joining us. Rohit, if you could just tell us what's happening in the markets. Do you think markets are just awaiting any major earnings recovery, a hint of earnings recovery, and you would see these flows that we are getting now can increase substantially?
Yes, probably so. We believe that the markets are waiting for the earnings to recover. Not earnings to recover, but more the markets are waiting for earnings to stop falling. The consensus earning estimates, which for the past 3 years started 18 to 20% for the next year and ultimately end up at being flattish to 5% kind of growth. The market is waiting that earnings downgrade cycle comes to an end. Once that happens, you will see the markets re-rate even further, because once that cycle stops, you will probably, with a lag of a year, get into a cycle where the earnings start to actually accelerate. And why we believe so that the earnings will actually accelerate is what's happened because of demonetization, because of GST, because of Uday reforms, because of the probable banking reforms. All of that will probably create a base, as it did in the years 2000 to 2003 when the markets were practically flat because the earnings were flat. And when the earning trajectory changed, we saw what happened to the markets from the 2004 to 2007-8 kind of period. We believe something like that is probably in store, where the Indian economy or the Indian corporate growth is at an inflection point where the economy could grow anywhere between 7 to 10%, the trajectory being lower being 7 and moving up to 10%. And the corporate earnings growth could be anywhere between 15% to 25%, again starting with a lower base and accelerating. And when the earnings start to accelerate, the forward earnings start to get discounted at a higher PE and the markets start to get even higher. This time around, the difference is, last time the market euphoria was led by the FIIs, but this time it is probably be led by the domestic investors, which is actually beneficial and even better for the market in general.
Do you see the kind of compounding that we saw in 2003 to 2007, which can happen again, or a 15 to 18% growth number would be cheered by the street?
I think as a starting point, 15 to 20% is a good number to go with. But we don't want to stick our neck out and say that it will happen at a higher rate than that, because as you said rightly, that for the past 3 years, for some reason or the other, the market has had to contend with disappointment. Now, having that in place, you do not want to really call it out. But at the same time, we do believe that the ingredients are there which are ready for takeoff. If that happens at some point, I don't know at what point in the future, maybe 2 years, 3 years, but in the next 3 to 5 years, you will see a point where the earnings growth will not be the normal 15-17%, but north of 20% and closer to 25%. Once that happens, you will really see the market getting to stratospheric levels, of course provided that the Indian macro stays the same and globally there is no big disruption.
Right now, Q4 earnings are expected to be impacted because of demonetization, but promoters like Uday Kotak said that they are seeing a pickup coming in. How would you relate this? If in this demonetization or GST impact still earnings become good, would investors be convinced that there is an earnings recovery?
Yes, everybody believes that the recovery is in place, and we do see initial signs of such improvement, not just in the banking space, which Mr. Kotak talked about, but when we speak to some of the other companies across all the sectors, most of them seem to suggest that the world or the Indian economy seems to have stabilized, the demand is coming back, supply issues are getting sorted, and things are getting back on track. Of course, there is the impending GST, which again creates a little bit of doubts in the minds of people to have the animal spirits back. Now, what do we need is some more investment. We cannot as a country just keep consuming. So we need the private sector investment to come back. Now, the private sector investment comes back only when the private sector investor or the corporate has the confidence that there will be enough demand in the future when he puts up new capacity or new supply comes in. And we do see initial signs of that coming back. So after 2 quarters of GST, I think you will see corporate India ready for a takeoff, where you will see private sector participation coming back, and you will see the private sector entrepreneurs putting capital to use where they believe there will be enough demand and the supply that they will create can be absorbed, and hence that will lead to the earnings growth that we are looking for.
As far as NPA resolution is concerned, what are you expecting from the government?
Well, it's too early to call that out. Why we say so is because the experiences in the past have not been so good. At the same time, what is good to see is that the government, along with the RBI and the other parties which are involved in it, are taking longer than estimated. Actually, we are happy that they are taking a longer time. When they are taking longer time, it means that they are going through the intricacies, the details of the whole process. See, it's very easy to say that provide capital or make a bad bank. Now, we also have exceptions to the case. What does a bad bank do? You just put some of the bad assets that mostly not the private sector, but the government sector is carrying into a bad bank. It does not really, in our opinion, solve the issue. Nor does just providing capital to the bad bank solve the issue. If the government was only to provide capital, it could have done so by providing capital to the entities which are currently having problems. What needs to be in place is a mechanism where the assets are ring-fenced. Now, there are 2 or 3 types of assets. Some of the assets are there which cannot be ring-fenced in a way which is desirable, in which case there will be a haircut which will have to be taken. Now, the question again comes, who takes the haircut? Is it the banks? Is it the promoters? Or is it the whole chain? Now, when it is just the banks who take the haircut, it is nothing but it tantamounts to paying money from your pocket and my pocket, because it is the budget and the taxpayers' money which eventually the government is using to capitalize these banks. So that cannot be the solution. So we are happy that the government is taking more time, but any kind of solution will have to bear in mind that it is not just the capital, but some of the discretionary valuation assumptions will have to be provided. Somebody, a professional management, or somebody or the authority to have that kind of sweeping powers where all the related parties can come to the table and think of a viable solution. Currently, the promoters do not have so much of their skin in the game, and hence most of the times what we see is that the interest from the parties for resolution is pretty low, and the mechanism itself is a little flawed for it to happen very conveniently and a smooth process. Now, the 2 main sectors which are impacted by it is the steel sector and the power sector. Now, if you see for the steel sectors, you are hearing noise that there are some bidders available for some kind of assets which are in trouble. But those bidders will obviously book at 30%, 40% of the book value. What happens to the rest 50 to 60%? Do we just assume that this is the capital which is being provided or being taken over by the ARC or some kind of a bad bank? Not necessarily. We have to work out a way where the existing promoters or all the parties involved in the chain also take a haircut, and then only a solution which is viable, which is long-term in nature, and which is good for the economy can be set in place. So we are happy, we are hopeful, we are wishful as a equity market participant and as a participant in the economy that things get rectified and things happen for the better. But at the same time, the nitty-gritties will have to really be sorted rather than just assuming that provide capital or take a write down.
The explanation that you just gave us, do you think that that makes private banks or NBFCs which are growing fast and are very well capitalized a clean overweight sector?
Well, I agree on the cater to growth statement that you made. It is absolutely a blinder in that sense for the private banks and the NBFCs. What we see now is that the 70% of the banking system is unable to grow or not growing either due to lack of capital or due to lack of opportunity. Let us not forget that it is not just lack of capital. Currently, there is no investment demand. Where do we see a company asking for $5 billion, $3 billion and it not getting financed? That's what we are talking about. We need the animal spirits back. For the animal spirits to come back, we need to get the confidence that the economy is here for a sustainable recovery, and that's when people will take the call to go and invest, to go and do capital expenditure. Currently, one of the reasons is that the public sector does not have capital, but at the same time, there is no demand for capital as of now. So as things normalize, by the same time, private sector, which is only 30% of the whole system, since it is smaller, it can continue to grow at a pace, or even if it continues to grow at a slower pace, it can easily decide to choose the credit that it wants to take on its books. And it actually makes life easier when you can decide the credit you want to take on your books.
In terms of themes for 2018-19, do you believe that a lot of companies are making huge free cash flows and a lot of companies have debt assets which they want to sell? So M&A becomes a very big theme or a very big trigger for the next year?
Absolutely. I think M&A is a theme because of 2 or 3 reasons. One of the reasons is what you are saying, that Some of the companies are highly leveraged, and some of the companies are in sectors where it is difficult for them to actually service debt. At the same time, a few other reasons is demonetization and GST, which moves a lot of unorganized moves to organized. So whoever has capital, whoever has sound free cash flows, will be players who will be looking to buy out players who have weak balance sheets. But at the same time, the guy right now who has capital is also in the ascendancy simply because he can call the shots. For example, if 100 rupee of asset is available at 100 rupees, there is absolutely no interest from the guy who has capital to buy it. Now, the guy who has capital will say, I'll buy it at 30 rupees or 40 rupees, and the rest 60 rupees will have to be taken as a haircut, or some kind of restructuring will have to be done amongst the existing owners or lenders or the whole supply chain. Only then, when the new guy comes at 30 rupees or 40 rupees, and then to try to turn it around, either using his financial muscle by lowering the cost of capital or the cost of debt for the new entity, or through some synergies, or through branding and some other initiatives, can this turn around. Just buying and selling of assets will not lead to any value creation in the long term for the economy.
If you look at the companies, or how to play this M&A theme, large companies buying into smaller assets, maybe at slightly higher prices also, but they get the scale, they get the brand that they want. That's what essentially you would look at?
Yes, rightly so. Scale is important, but scale is always important at a price. A common mistake that most of the companies make in making an acquisition is they try to imply their multiples on the acquiring company. Now, it has always got to be a different mindset. When you go and acquire a company which is not of the same standard as you, and you are hoping or assuming that you can make some changes or create value out of it, you have to always assume not your multiple, but that company's multiple, and then arrive at the fair multiple, because you would want that after you merge, the whole console entity gets the same multiple or valuations that the market was giving to your standalone company. To do that is not such an easy job. Around the world, more than 95% of mergers and acquisitions end in failures. And hence, you have to be really choosy. What is a strategic fit? Not just for the sake of having revenues or market share, should somebody be looking out to invest and increase their size. But people who are more prudent, who will look to deploy their cash more judiciously, are the people who will be winners in the long term. And that's what we believe will happen.
Will large cap M&A, say from the top 200 companies, can it also change the outlook for the Nifty 50 earnings? So something like Idea, Vodafone that we saw earlier, a couple of such more deals, and the synergy benefits in the top 200 companies could increase?
That is possible, but that's not what the market is looking for in the long term to drive earnings through synergy benefits. The market is looking for a more vibrant economy and a more broad-based earnings culture. Now that happens when the sector or the economy starts to do well. What we are talking about, or the question you are asking, is about consolidation. Now, consolidation will have benefits for the console entity, but it also have the pitfalls. For example, there will be job losses probably that will happen, because when you talk of synergies, there will be probably some cut in workforces, some kind of infrastructure rationalization, and all those kind of things. So it is not something that the market really wants to go higher on these kind of assumptions. The market will be really happy when the economy bottoms out, when demand comes back, when supply bottlenecks get sorted out, and the earnings trajectory for the BSE 100 or 200 companies as a whole, and not just Nifty as a whole, starts to look up. If you talk about earnings, even with flat earnings, you could always find sectors or companies in a particular year which will give you a 20-30% earnings growth. In the last 3 years, the Nifty earnings may be flat, but there are enough companies which have grown at a higher than Nifty earnings. That will happen. But what we want is the earnings to get broad-based, and that will happen only after things normalize in the economy.
You referred to the vibrant economy. Say if that happens, what happens to flows? DII flows have been strong, but do you expect it to continue?
Absolutely. That is one theme that we are very, very positive upon. That is not just a function of the economy starting to look up. That is also a function of what has happened because of demonetization and the impending GST. I've talked about it. We believe that the amount of money that the banking system is getting after demonetization is humongous. Even if you assume 20-30% of that money starts to get into the financial savings, which is insurance through ULIPs, or into the mutual funds, the DI inflow is something what we believe will keep surprising the markets. And this time around, we believe that any kind of multiple re-rating, or if the market were to get into a zone which is belying of its fundamentals for a brief period of time, it will more be led by domestic liquidity rather than foreign liquidity. And when it is led by domestic liquidity, the probability of it sustaining is higher, because that kind of liquidity does not go away in a day, whereas a foreign liquidity can go away when the macro changes. Not just Indian macro, but the macro can change for the world, and there is a lot of change in the socio-economic development, geopolitical development, or the currency development. But when it is led by domestic money, the market can trade at higher multiples for longer.
Do you think the ease of investment into e-assets or mutual funds, insurance, or any other paper has become quite easy? That is one of the key things why investment is picking up and it's much more sustainable?
Well, of course it helps. All of this are part of the digitization drive that most companies are now trying to move towards. So after the demonetization event, what you see is the winners are people who have adopted the change, or the winners will be the ones who will adopt change and move quickly, move faster, become lighter, become nimble. Those are the kind of companies or sectors which will be eventual winners. We see that happening. As you said, now it is available at the click of the button. Sitting in your room, you can invest in an insurance or a mutual fund product. That kind of ease also means that the shift is earlier, the shift is faster, and all of that at the margin helps financial savings. And as it is right now, physical savings is not something people are very gung-ho about. And so when you get the ease, it is easier for people to convert.
Which sectors will you be overweight on, considering that you are expecting markets to go up, considering you are expecting earnings recovery to play out?
Yeah, so to play the secular stories, as we talked about, people who embrace change will conquer. Now, the people where we see are embracing change are the private sector banks. They have been nimble-footed, some of the NBFCs as well, where since they are small within the system and they are nimble, they have the capital as well. Most of them are well capitalized, and they're investing a lot behind technology. When I say technology to embrace change, where you can reach out to the consumer in a way which is more effective, more cost friendly, and you can get more customers without spending too much on physical infrastructure. So we are very positive on the private banking space. We are also positive on the discretionary space, which actually took a very big knock after the demonetization. What we see, or what we believe, is that the discretionary space is making a comeback. Some of the channel checks that we do seem to suggest that demand is coming back, and some of the sectors where the cash component in the dealing was high, that seems to be changing and has changed at the margin. With GST, it will accelerate even further. So all those sectors in the discretionary side, where unorganized is a very large portion, and the unorganized, even though the player may be a 40-50% market share, he will stand to gain disproportionately, not because his market share goes from 50 to 60 or 70, but because the shift from unorganized to organized will be very, very fast. So some discretionary plays, and maybe some cement plays, and some select auto plays as well, where we believe demand will make a comeback.
Thank you so much, Rohit, for taking out time for us. Always good to get a perspective.
Thank you. Thank you.